Welcome back to the InvestTalk classroom. We took to Instagram and asked you to ask us anything. So, Luke, what's our first question?
Frankly, I was scared when we said ask us anything.
Yeah,
But thank you for all the excellent and appropriate questions.
They were very appropriate, yes.
So the first question is thoughts on DFUV, possibly Luke's old company he worked for. I can take this one. DFUV is a dimensional fund. I did used to work there for about 6 years. It is the U.S. market-wide value fund.
Okay.
So the question
is... It's a value shop.
It's a value shop.
Yeah.
It's a value fund. What do I think of it? I think that all of Dimensional's funds have what I look for in mutual funds or ETFs. They are low turnover. They are low cost. And they have a succinct strategy. And specifically for value, just like you mentioned, that's their thing. They have always done an excellent job of attacking value. Mm-hmm. So then the question becomes, is that a good fund for now? Is a market-wide value strategy what you want? And that is more of a personal question. But certainly if you are looking for a market-wide value strategy, DFA's version of it is an excellent one.
Great summation. Now, the next question is about the Instacart IPO. Thoughts on the Instacart IPO? And I'll take this one because, IPOs in general tend to be not great investments. They tend to be overvalued. I always think of it as if you start a company or were early on in building a company and you owned a lot of shares of it and you're going to go sell those shares to the public, do you think you're going to sell them at an advantageous price to you or an advantageous price to the buyer? You're probably going to do it when the valuations seem a little excessive, right? You're not going to do it unless there's some fire sale, which typically IPOs never happen. In that case, it's usually a company that is hot, is doing well relatively, and the price tends to be very high. And also the investment bank, they have a lot of incentive to get that price as high as possible because they typically earn a percentage of the net proceeds of that IPO. So Instacart is a business. I haven't looked at the financials. Have you seen the financials?
I have not, but I will add that generally speaking, historically, all the empirical evidence shows that IPOs tend to underperform the market over the first year. Mm-hmm. Why is that? It's because of the structural issues you mentioned, which is there's an incentivization problem in that the banks that value it want to value it low enough for themselves and their institutional clients that they can make money on the open market. Mm-hmm. And they're making that margin, and then it usually only goes down from there. The other part is the holder dynamics and lockup periods, and with volume and liquidity being in a way that is unrealistic because of things being locked up for almost half a year. So everything that goes along with IPOs is just not part of the normal price discovery process. So for me, anytime I'm looking to invest in a company, I want to know that the information that I'm getting, there's no information asymmetry, there's nothing going on here. And so that is one of the reasons why over a year IPOs tend to underperform. I don't know if that'll happen with Instacart. I imagine it probably will.
Yeah, and it's really all about the float, right? Yep. The float dynamics early on are not realistic because after 6 months, typically it's 6 months, it can change depending on the IPO, but typically 6 months, that's when the lockup period goes away. And if you're a shareholder before the IPO, now you can start to sell those shares. And so that typically puts more shares on the market and depresses the stock price after those 6 months. So not a big fan typically of IPOs. All right, what's our next question?
Our next question is wondering if you prefer the equal weight S&P as opposed to the, I got it cut off, but I imagine it's the normal S&P.
Yeah. Well, I think it's pretty simple. Over the long term, smaller companies, smaller caps tend to do better. They're more volatile. But longer term, if you go past kind of the financial repression post 2008, if you ignore that kind of period that was kind of an anomaly, you'll see that over decades, smaller cap companies tend to do better. So I would say equal weight is probably better over the long term. What would you say?
Neither.
I
hate them both.
You hate them both.
I think that people too often think of the S&P as a proxy for the U.S. market, and it's not. Okay. Because the S&P indices, whether it's equal weight or if it's their normal weighted one, it is selected by committee. It's not a representation of really anything other than what a committee thinks are the names that belong in an index that represent the United States. So,
and it's 500 names, not thousands of names.
It's not thousands of names. And so when you take, even if you take an equal weighted index, do you really know if you're giving a larger weight and a meaningful weight of small caps? I don't know. I don't know what names they're going to put on next week, next year. I don't like the index at all whatsoever.
I don't either.
So I would choose neither.
That was not the question.
This is true.
The question was, do you like small cap the equal weight or the traditional S&P? And I would just simply say I would like the equal weight.
Can I add one more thing?
Sure.
I would say that indexes, more than anything, are tools for some type of analysis, in my opinion. I think they're a great place to start in looking at something. I think that in terms of a investment strategy, you can do better over the long term.
Leaves a lot to be desired.
It leaves a lot to be desired, but they do tell you things. So the equal weight tells you how broad is a market outperformance or underperformance.
Yeah. That's a good way to use it.
It's a good way to use
What's
it.
outperforming?
What's outperforming?
Yeah.
If the normal S&P is outperforming by a lot and the equal weight is underperforming, like is happening now, you have a rally that does not have the breadth that would show a resilient economy, right?
Yep.
So I think the indices offer the ability to have a lens into hints about what's going on in the market. I don't necessarily think they are good investment strategies.
Yeah, that's the value that you can find there with those indexes. All right, the next one is talk about the top 5 or 10 things for fundamental analysis to look at. So, Luke, what would you say your top few factors that you're looking at when you're analyzing a company?
Number one is cash flow. For me, cash is king. Cash is all that is required to operate a business. It always makes me laugh when people talk about EBITDA, and it makes Warren Buffett laugh as well. And his point is, why are you looking at a metric that doesn't take into consideration all of the cash requirements of operating a business? So cash flow is incredibly important. How profitable a company is, not just its relative profits relative to its asset base, but what do those margins look like? So are those margins in line with historical averages? Are they over earning? Are they under earning? What's going on there? For me, the most important aspects of a business are not just its profitability, but how much cash is actually running through that business.
Yeah. And I would say going to profitability, return on equity, return on assets. I really like return on assets because return on equity can be inflated by an over-levered balance sheet. And return on assets is pretty clean when it comes to how profitable business is. Now, it does depend on the sector, but those are the ones I like to look at along with return on invested capital. So those are some good ones, good measurements of how profitable a business is. And then the balance sheet, especially in this environment, balance sheets are crucial. So what is the interest coverage ratio?
Yeah.
Are they able to continue to pay that interest rate over time? Or are they going to have to refinance maybe in the near term? Maybe they're locked into 3 or 4% rates and now they have to refinance in a year, and now our rates now are much, much higher, and they're going to have to refinance at 8-9%, and suddenly that can change the cash flow, going to your point of the business overall. So I really like understanding that, and then where those cash flows are coming from. So not just cash flow, but operating cash flow, because companies can raise money. There's a lot of companies out there that are serial issuers of shares or debt, and that is a way to get cash flow into the business, but that's not sustainable cash flow. Sustainable cash flow comes from the pure operations of that business. So I like to look at that. Any other ones?
Also looking at, year over year changes on balance sheets. If your asset base is growing drastically year over year and it's not from internally generated profits, we have a problem here. If you are a serial issuer of shares or now a serial issuer of debt, you're taking on way too much risk, and that is not a good company. Those companies do tend to underperform.
Yeah, and I like what you said about over time, because a lot of people look at snapshots of a business and they say, okay, the profits are this or the profits are that, and at the end of the day, it's not about what profits it made in the past. It's what the profits are going forward. And so the consistency of that cash flow, of those earnings, are vital to me when I'm looking at these the fundamentals of a business. So try not to get stuck into one snapshot, but understand the business over different economic cycles, different interest rate cycles, et cetera.
Let's do one more question. How to adjust portfolio to benefit from U.S. onshoring? Your favorite topic.
Yeah, I mean, I think clearly it's industrials. It's a great way to gain exposure. Now, you're going to go through boom and bust times. I think that's what's most important here, is to understand that these are secular trends, but there are cyclical trends as well. And right now, obviously, we're going through a downtrend in the economy to some degree. You could call it a major one or a minor one. It's clear the economy continues to slow to a degree, and that's weighing on certain parts of the market, including industrials right now. But secularly, if we continue to reshore manufacturing, not just here in the US, but I think just in North America in general, the industrial space is going to do very, very well. And then raw materials, energy, all of those endeavors to build factories and reshore manufacturing are going to need a lot of raw materials and energy. And so those would probably be the three main places I would focus on.
Yeah, I mean, in terms of picking individual companies, I think for most investors, it's difficult because you really do need to have tools that allow you to look at supply chains of companies, right? So we have tools that help us to see where, what percentage of revenue is coming from which regions, what are the top trading partners with that company. So finding those individual companies that have shored up their own individual supply chain, I like saying individual.
Yeah.
So finding those specific companies that have been able to shore up their supply chains to the point where they don't have the exposure to the stresses of geopolitical conflict is really crucial here, right? So not every company within the industrial space is going to be affected by a ban on some material coming out of somewhere in sub-Saharan Africa. Not every car company is going to be affected by a ban on battery technology coming out of China. So I think that now more than ever, it is becoming a more company-specific risk that investors need to look into.
Yeah, company specific is very important. It's hard to paint a broad brush because they all have their own idiosyncrasies with their supply and demand dynamics. But the broader trend clearly is to reinvest and spend CapEx on developing a supply chain that is more resilient. And that can mean many different things. But for the most part, it means building true production capacity in friendly countries.
Yeah.
Well, that about wraps it up. Thank you for all of your questions. And for the rest of you, remember to follow us on Instagram at InvestTalk Podcast.